We're going to be looking at a couple of problems that deal with an intangible asset known as goodwill. We'll be covering this to a much greater extent in advanced accounting. This is simply an introduction. Goodwill occurs when a company buys another company. Goodwill cannot be internally generated. The definition of goodwill is the amount by which the price that we pay for the acquisition exceeds the fair market value of the net assets that are acquired. The difference between what we paid for and the fair value of the asset represents the present value of future cash flows. If an investment banking company works for a client in the merger and acquisition, they will spend a lot of time to come up with the proper purchase price, whether they're working for the buyer or the seller. And much of their work goes into determining both the fair value of the assets and liabilities, come up with the net assets, and also on these future cash flows. These are major guesses by companies. And recent history has shown us that oftentimes companies overstate the value or believe that a company is more valuable than it actually is. And as you will learn with advanced accounting, well, that leads us to ask the question, is the goodwill still good? So let's just start with a very simple example where we're looking to determine the goodwill for an acquisition. We're going to use exercise 10.6, and we see that one corporation is purchasing all of the common stock of another, so in effect they will have control of that company. So they are purchasing for this $17 million the fair value of their assets minus the fair value of their liabilities and the future cash flows from their operations. That future cash flow will be represented by goodwill. In our worksheet, we've set up the different classifications of assets and liabilities, and we have put the value for both book, what the accounting records say they're worth, and our assessment of fair value. So let's calculate the net assets. To do that, we're going to take the assets and subtract out the liabilities. We'll do the same thing with our fair value. We can simply copy and paste. And we've determined that the book value of the net assets is $8 million. Fair value is $13.5. Well, we paid $17 million in cash. Millions. Next, we have to determine whether we should use the fair value of the net assets, the book value of the net assets, just the fair value of the total assets, or just the book value of the total assets. Again, remember, the definition of goodwill is the amount by which the purchase price exceeds the fair value of the net assets acquired, in this case, 13.5. The fair value of the net assets. We're going to be subtracting that, and our goodwill is equal to 3.5 million. Well, let's take a look at another problem, exercise 10-7. In this problem, we are told that the company is purchasing all the stock of another company for $11 million. The book value of the net assets, assets minus liabilities, was 7.8. The fair value of all the assets and liabilities are equal to book value except for these three classifications. So this is a little trickier in that they don't give us the book and fair value for each. We have to understand that we are going to have to make adjustments to determine the difference between book value and fair value on the information given. So let's start building up problem. Right? We are going to pay $11 million for the company. Now they don't give us the fair value for all of the net assets, but they tell us that the book value in total was 7.8 and there are some exceptions. So we're going to have to start here with the exception. So we're going to go to the book value of the net assets. We're going to subtract that out and determine our goodwill. And that is 7.8 million. Now our property, plant, and equipment, the fair value exceeds book value by 8 million, excuse me, by 1,400,000. So we are going to subtract out the difference of 1.4. The intangible assets, the book value is 200,000, fair value of $1,200,000. So there's a $1 million difference that will also be subtracted out. And then finally, we have our receivables. And in a little twist, the book value, 1.3, is higher than fair value. Now, when the fair value is higher than book value, we subtracted it. Why? Well, again, the definition of goodwill is the amount by which the purchase price exceeds the fair value of the net assets. Well, since the fair value is greater, in order to come up with the goodwill, we subtract it. But in this case, the receivables, the book value is higher. We don't believe the receivables are worth as much as the books, and that is a difference of 200,000. So now we're going to total goodwill by taking the amount paid, subtracting out the book value of the net assets that haven't been adjusted to fair value. We then have our fair value adjustments, and the sum of all of these will equal our goodwill of 1 million. Again, goodwill represents future earnings. The definition is the amount by which the purchase price exceeds the fair value of the net assets acquired. The company we acquire is going to be maintaining their records on book value. We'll be paying for fair value. We will have access to this information and make adjustments to fair value. So often in the real world, this is the case. We know what the book value of the net assets are. We have identified specific assets and liabilities where there's a difference between book and fair value, and that's what we use to determine goodwill.